greed usually emerges at the peak. The anatomy of psychological climb in market cycles. There's an interesting paradox in financial markets. When risk is at its highest, risk perception is at its lowest. As prices approach their peak, fear decreases, and greed increases. This is no coincidence. It's a natural consequence of behavioral finance and human psychology. 1. Market cycle and emotional evolution. In the classic market cycle, emotions progress in this order. 1. Doubt. 2. Hope. 3. Optimism. 4. Enthusiasm. 5. Greed. 6. Denial. 7. Panic. 8. Despair. The peak usually occurs between enthusiasm and greed. Because a long period of growth generates confidence. Past risks are forgotten. The ingrained belief that dips are buying opportunities is formed. 2. Overconfidence. Daniel Kahneman and Amos Tversky have shown that people tend to over-rely on their own predictions under uncertainty. After a long period of growth, an investor thinks, "I've figured out the market. This time it's different. Risk is under control." As success increases, risk appetite increases. As risk appetite increases, positions grow. As positions grow, the system becomes more fragile. 3. Herd mentality. Humans are social beings. If everyone around you is winning, risk becomes normalized. Being cautious is perceived as missing an opportunity. Critical voices are silenced. During peak periods, the following sentence is frequently heard. "Everyone is winning. Why should I be left out?" This situation is known as herd behavior in financial literature. 4. Storytelling power. At its peak, there's a powerful narrative. New technology, new economic order, new monetary policy, and a new era. The stronger the story, the more valuation is disregarded. At this point, investors buy the story, not the price. 5. Distortion of risk perception. If there hasn't been a decline for a long time, the brain makes the following inference. The system must be safe. When volatility decreases, people think the risk has decreased. However, often low volatility is a harbinger of excessive risk accumulation. 6. Historical pattern. Many large bubbles share common characteristics at their peak. Credit expansion increases. Leverage increases. Valuation metrics are disregarded. The narrative of "this time it's different" spreads. In their study, "This time is different," economists Carmen Reinhart and Kenneth Rogoff, examining financial crisis, demonstrate the following. Before major crisis, risk is systematically underestimated. In other words, the peak is usually when one feels most comfortable. 7. Neurobiological mechanism. During the bull run, dopamine levels increase. The brain strengthens the reward system. Risky behaviors become more attractive. As gains are repeated, the investor begins to confuse luck with skill. At this point, greed strengthens not only emotionally, but also biologically. 8. The cost of greed. 1. Buying at the peak. The most expensive prices are usually reached at the moment of greatest optimism. 2. Excessive leverage. Risk is increased, margin is reduced. 3. Significant damage in a sharp correction. Panic spreads rapidly when the decline begins. 4. Psychological collapse. An investor who experienced euphoria at the peak may experience traumatic events during the decline. 9. Why greed emerges at the summit, not the bottom? Because at the bottom, everyone is afraid. The news flow is negative. Confidence is low. At the summit, past performance is strong. Risk is invisible. Social proof is at its maximum. The human brain projects the recent past onto the future. As the rise continues, the possibility of a fall is erased from the mind. Strong outcome. Greed generally emerges at the most costly point. Because long-term success inflates self-confidence. Low volatility generates confidence. Herd behavior suppresses risk perception. And at that very moment, the thought arises, it will go up a little more. But in financial history, major losses generally begin at the point where a little more is said. Lesson for the long-term investor. As enthusiasm increases, caution increases. Recalculate risks when everyone is relaxed. Don't abandon the discipline of valuation. Even when you're at your most optimistic, consider the worst-case scenario. Because the market is generally fragile when it seems strongest.